Welcome to The Explainer. Have you ever just stared at a complex CFA question about financial statements and not known where to even begin? Well, you are in exactly the right place. Today, we're building your toolkit. We're going to break down financial analysis, and we'll start with one of the most important metrics out there, earnings per share. So here's our game plan for today. We're going to kick things off with the big why behind all of this analysis in the first place. Then we'll get our hands dirty with the single most watched number in all of finance, earnings per share, looking at both its basic and its diluted forms. After that, we'll zoom out and look beyond EPS to some other key statements. And finally, we'll wrap up by tackling a really important question. In a world full of AI, what is an analyst's real job? Okay, so let's start at the very beginning. What's the whole point of this exercise? I mean, before we dive into a single calculation, we have to understand the fundamental goal of all financial analysis.
The main role of financial statement analysis isn't to be a historian, just looking backwards to make sure the numbers add up. It's really about being a strategist. It's about using that data from the past and the present to make incredibly smart, informed decisions about the future.
And that, right there, is the crucial takeaway. We analyze the past to help predict the future. This isn't just an academic exercise. It's a super powerful forward-looking tool that drives billions of dollars in real-world investment and credit decisions every single day. Now, for any of this analysis to actually work, everyone needs to be playing by the same rules. And that's where organizations like the International Accounting Standards Board, or ISB, come in. They create the IFRS rulebook that most of the world uses. And this is so important because it ensures we can compare a company in, say, Germany to one in Japan on a true apples-to-apples basis.
All right, with that foundation in place, let's zoom in on what is arguably the most watched, most talked about number in all of finance, earnings per share, or EPS. This is the single metric that can literally make or break a company's stock on earnings day.
So the very first step in any EPS calculation is to look at the company's capital structure. It's like a fork in the road. You have to ask, is it simple or is it complex? If it's simple, we're talking just common stock, then you calculate basic EPS. But if it's complex, with all these other potential new shares lurking from things like stock options or convertible bonds, then you have to go that extra step and calculate diluted EPS. So for companies with that simple structure, we start with basic EPS. This is the bedrock formula you have to know. You just take the net income, then you subtract any dividends that are owed to preferred shareholders, because let's be honest, that profit doesn't belong to us common shareholders, and then you divide all of that by the weighted average number of common shares that were out there during the period. Okay, theory is great, but let's actually put it into practice. Here we have a pretty typical scenario. A company's share count changes midway through the year. So, how do we accurately calculate its basic EPS? Let's break it down. Okay, let's walk through this together. Step 1, you see it on the left, we have to calculate the weighted average shares. So we take the 1 million shares they had for the first half of the year and the 1.1 million for the second half. That gives us our denominator, 1,050,000 shares. Now for step 2, we just apply the formula. We take that 1 million in net income, divide it by our new share count, and that leads us to our final answer, a basic EPS of 95 cents. But you see, basic EPS, it only tells part of the story for a lot of companies. I mean, what happens when there are all those stock options or convertible bonds just sitting out there waiting to become new shares? Well, that's where diluted EPS comes in. It gives us a much more conservative and often more accurate look at each shareholder's actual claim on the company's profit. Exactly. Think of diluted EPS as a conservative what-if number. It answers a really critical question. What would happen to our earnings per share if all of these potential shares, from options, from convertibles, you name it, suddenly became real? It's designed to show you the floor, not the ceiling. All right, let's tackle our first dilution problem. This time, we're dealing with convertible preferred shares. So Sublime Corporation has 2 million of these things, and each one can be converted into 2 common shares. Let's see what kind of impact that has. Let's just follow the logic here. First, we assume the conversion actually happens, which adds 4 million new shares to our denominator. But here's the really crucial part. If those preferred shares are converted, the company doesn't pay the preferred dividends anymore. So that dividend money actually stays in the pot, available to the new, bigger pool of common shareholders. So with our adjusted numerator and our new denominator, we get a diluted EPS of $3.70. Next up, a totally different kind of challenge, stock options. Now, you can't just add all the potential shares from options straight to the denominator. No. Instead, we have to use this really clever accounting technique called the treasury stock method. The logic behind this method is actually pretty cool. It runs a little hypothetical scenario in the background. It assumes that the company gets a big pile of cash when employees exercise their options. Then, it assumes the company instantly uses that cash to go out and buy back its own stock. So the actual dilution is only the net difference, the new shares that are left over after that hypothetical buyback. Okay, let's trace the flow right on the slide. First, we calculate the proceeds. 100,000 options at $20 each brings in $2 million. Next, how many shares can they buy back with that cash? Well, at $25 a share, that's 80,000 shares. So what's the net increase? Well, 100,000 new shares were issued, but we hypothetically bought back 80,000, leaving a net of just 20,000 new shares. We plug that number into our formula, remembering to account for those preferred dividends, and we get our final diluted EPS of $5.54. Look, a great analyst knows that you can't just focus on one number. The income statement is absolutely crucial, but the cash flow statement and the balance sheet, they tell their own vital parts of the company's story. So let's expand our toolkit a bit. Here is a powerful and super simple rule of thumb for analyzing the statement of cash flows, especially when you're trying to reconcile net income to cash from operations. An increase in an asset, like inventory, means cash went out the door, so they move in opposite directions. But an increase in a liability, like accounts payable, means you held onto your cash longer, so they move in the same direction. This little mental model is a huge, huge time saver. And for any analyst working on a global scale, understanding the difference between IFRS and US GAAP is non-negotiable. And this table highlights a massive one. Just look at that IFRS column. See all the ORs? IFRS gives companies flexibility. They can classify things like interest paid as either operating or financing. US GAAP, on the other hand, is much, much stricter. This flexibility can dramatically change how a company's cash flow statement looks, so it's a critical thing to watch for when you're comparing companies. So, we've mastered the calculations, but the final piece of the puzzle is understanding that an analyst's job goes so far beyond just using a calculator. It's about way more than just getting the right number. Ultimately, your value as an analyst isn't being a human calculator. I mean, software can do that in a heartbeat. Your real value lies in the interpretation, in weaving all those numbers into a coherent story about where the company is headed. You're the one who provides the context, the insight, and the strategic recommendation. And this brings us to a final, pretty provocative thought. As automation and AI get better and better at handling the mechanics of calculation, what is it that truly sets a human analyst apart? Well, it's the ability to interpret nuance, to ask the right questions, to connect seemingly unrelated dots, and to build a strategic narrative. That is the skill that will always, always be in demand.